Financial Accounting, Chapter 7. Introduction. This is a quick reference guide for credit professionals who are new to requesting and analyzing financial statements, or who are transitioning to credit from other departments, accounts receivable, accounts payable, sales, etc., and don't have much or any experience with financial statements. The information in this handbook can also be used by more experienced credit professionals to improve and strengthen their financial statement analysis skills. Ratios and percentages. A financial ratio is a comparison of two statistical variables extracted from a company's financial statements. Numerous standard ratios are frequently used in accounting to assess an organization's or corporation's overall financial health. Managers, creditors, and present and potential shareholders of a company might use these financial ratios. Furthermore, security analysts utilize these financial statistics to compare and contrast the strengths and shortcomings of different organizations. Profit ratios. When analyzing business productivity, most companies refer to profitability ratios by comparing income to sales, assets, and equity. 8 of the most frequently used profitability ratios are gross profit margin, EBITDA margin, operating profit margin, net profit margin, cash flow margin, return on assets, return on equity, return on invested capital. Profitability ratios. Profitability ratios are a class of financial metrics used to assess a business' ability to generate earnings relative to its revenue, operating costs, balance sheet, assets, or shareholders' equity. Over time, using data from a specific point in time, profitability ratios can be compared with efficiency ratios, which consider how well a company uses its assets internally to generate income, as opposed to after-cost profits. Liquidity ratios. The liquidity ratio expresses a company's ability to repay short-term creditors out of its total cash. The liquidity ratio is the result of dividing the total cash by short-term borrowings. It shows the number of times short-term liabilities are covered by cash. If the value is greater than 1.00, it means it is fully covered. Liquidity ratio may refer to reserve requirement, a bank regulation that sets the minimum reserves each bank must hold. Acid test, a ratio used to determine the liquidity of a business entity. Interest cover. The interest coverage ratio is a debt-to-profitability ratio that determines how readily a business can pay interest on its outstanding debt. Divide a company earnings before interest and taxes, EBIT, by its interest expense for a particular period to calculate the interest coverage ratio. The TI ratio, time interest earned, is another name for the interest coverage ratio. This method is frequently used by lenders, investors, and creditors to assess a company riskiness in relation to its present or prospective debt. Funds management ratios. Asset management turnover ratios compare the assets of a company to its sales revenue. Asset management ratios indicate how successfully a company is utilizing its assets to generate revenues. Analysis of asset management ratios tells how efficiently and effectively a company is using its assets to generate revenues. They indicate the ability of a company to translate its assets into sales. Asset management ratios are also known as asset turnover ratios and asset efficiency ratios. In accounting, inventory turnover measures the number of times inventory is sold or used in a period, such as a year. The equation for inventory turnover equals the cost of goods sold divided by the average inventory. Inventory turnover is also known as inventory turns, stock turn, and turnover. Inventory turnover equation. The formula for inventory turnover. Inventory turnover equals cost of goods sold, average inventory. The formula for average inventory. Average inventory equals beginning inventory plus ending inventory divided by the 2. The average days to sell the inventory is calculated as follows. Average days to sell the inventory equals 365 days divided by the inventory turnover ratio, Introduction to investment ratios. An investment is an asset or item acquired to generate income or appreciation. Appreciation refers to an increase in an asset value over time when individual purchases a good as an investment. The intent is not to consume the good, but rather to use it in the future to create wealth. For example, an investor may purchase a monetary asset now with the idea that the asset will provide income in the future or will later be sold at a higher price for a profit. Some general issues. Accounting teams that use technology are more able to respond to changes and problems, such as the supply chain and revenue disruptions that may occur in 2020. So, what are the most pressing issues that accountants are confronted with these days? Cash flow, acquiring new talent, reacting to new tax and regulatory changes, and continuing to adjust to remote workers are still some of the accounting team's biggest challenges. Cash flow, financial reporting, hiring and retaining talent, automation and artificial intelligence, upskilling, tax law changes, regulatory changes, new accounting standards, expense management, payroll management, cybersecurity, remote work, low morale, accurate financial forecasts, keeping up with new technology and tools,